My bet is that something will break really badly and there will be a pivot. I don't think it'll be immediately. I think they really need to really make it happen badly first. So again, they want you to think, it doesn't matter. The debt doesn't matter. The grading doesn't matter, because after all, it's the markets that's going to determine the interest rates. Well, that's not entirely true with all the meddling that the central banks do to jury-rig all of the interest rates. But I don't know. I'm going to let you decide whether or not it really matters to you. People cannot but hope that their currency will regain some of its purchasing power, but it never does, because the design is for it not to. Debate to shift from how high to hike to how long to hold. But don't worry, because they're coming out and saying, yeah, I think the Fed can pivot. I think we don't have to raise rates anymore. Yeah, because the system is flipping falling apart. Do they need to pivot to control interest rates and support this bond market? Do they need to pivot so that the Treasury can issue tons more debt? You really have to look at this. They want you to think that the levels of debt don't matter. They want you to think the rising interest rates can still engineer a soft landing. It's garbage. How many times can you be lied to when you do not know the truth? Well, you know the truth. What are you going to do? This is good money. This is real money. This has demand in every single aspect and every single area of the global economy. What do you have here? Lots of downgrades, don't you? That you can't even use these as a tool of barter anymore. So is that where the US dollar is headed? Yep, absolutely 100% is. You got to have this for your foundation to protect whatever you have in the fiat money system and to put you in a position to not just survive this, but even thrive through it. So on the other side of it, you're in a much better position. You are not, you own nothing and are miserable. No, this is the federal debt. Now, I want you to keep in mind that these gray bars are official recession. And you might notice that as we were lifting off into this new debt-based system, then when we would hit that gray bar, the debt would grow faster and faster. And look what happened since 2008. That's a hockey stick. That's exponential. Debt ceiling has been suspended until 2025. So basically, they can spend any amount of money that they want over this next year and a half. Isn't that convenient? But they had to do it just to avoid a default, but they really were going right up to that line. At what point will they cross that line? We were now at $32.682 trillion in debt. That's over $97, almost $98,000 per citizen. So that would include babies, but $253,668 per debt per taxpayer. We are the ones that are responsible for this debt. And we're not done yet. The debt is going to get a whole lot higher, and so is your bill. But they don't tell us what this really means. It means, like they said in England, get used to it. You're just going to be poorer. Well, don't get used to it. Protect yourself. Become as self-sufficient and indispensable to yourself as possible. Become your own central bank, become your own grocery store, become your own utility company. Get this stuff done. Food, water, energy, security, barterability, wealth preservation, community, and shelter. This is what we all need to sustain a reasonable standard of living. Because, you really need to ask yourself, do you believe all their garbage and all their lies? Do you believe that they're doing this in your best interest? Or are they doing it so, really, what's the job of the government, especially big government, is to remain big and take even more. Take even more of your liberties, even more of your freedoms. CBDCs, hello. And the job of the central banks is to protect the central banks. It's not to protect you. Well, I think it's time we take it back and say, no, this is not okay with us, because they're looking at now an estimated borrowing that was up from $733 billion to $1 trillion in just this quarter, and that's happening today. They've been issuing the debt. We'll see where it goes, but who's going to be buying this back? Well, if the market isn't out there buying it, if the Federal Reserve isn't out there buying it, because remember, they're trying to run off their balance sheet, then who might do that? Might it be institutional investors that are investing your money? Think about that. The Treasury said Monday that $83 billion of the increase in borrowing estimate for the current quarter was due to projections for weaker revenues and higher spending. Well, most of the revenues come from payroll taxes. So are they trying to tell us that they expect unemployment to grow substantially, weaker revenues? And they're certainly telling us they're going to keep spending money because they want things to look like they're okay. They're not okay. But this is what I really also want to point out. U.S. racks up $652 billion in debt costs as rates hit 11-year high. Now back, I think it was 2009. I said to myself, at that point, the deficit was running about $1 trillion, which means that they took in $1 trillion less than they spent. But yet the debt that we were servicing at that time was $13 trillion. Now it's over $32 trillion. But then it was $13 trillion. So I said to myself, well, gosh, if we've only spent $1 trillion more than we have coming in, why are we servicing $13 trillion in debt? You go into the Fed, you can go to the data that backs up all of these numbers. And that's what I did. And what I discovered, so even this is garbage. It's not true. What I discovered was all of that was compounding interest. Because when you're spending more than you're taking in, you're not even paying all of the interest on the debt. So think about you with the credit card. If you don't pay all of the interest plus some of the principal, that interest then goes into the principal and starts compounding. So you're paying interest upon interest upon interest. So how high is that now? Well, I haven't done that study again. But if you stop and think about it, we're looking at maybe 1.3 or 1.5 official deficits, but we're servicing $32 trillion in debt. So $652 billion in debt costs, maybe additional debt costs from the higher interest rates, but absolutely they're compounding interest. And look at how this is surging. This is just the interest rate surge. That should frankly really scare the crap out of you because that's not going away. And the US budget gap widens 170% in the first 9 months of the year. This is savings. This is debt. I like this. In gold and silver in my possession, I trust. My bet is that something will break really badly and there will be a pivot. I don't think it'll be immediately. I think they really need to really make it happen badly first. And this is the Fed's balance sheet, presuming you believe them. And you can see this is January 2018, because prior to 2008, we're at 800 billion. Now we are still above 8 trillion just in that little period of time. But they are not replacing the maturing bonds. So you can see this decline right there. So if the Fed, who's been buying a ton of treasuries, is no longer buying the treasuries, and you see this attempt to run it off and then boop, and now we've got another attempt. We'll see how long this goes. Normalization, what's normal? We've been in extraordinary measures forever. The Fed is shrinking its holdings of treasuries by up to $60 billion a month by letting securities mature without replacing them.